Hello, welcome to the show. It's the Money and Markets Show, and I'm Charles Boyd, your host. We are coming to the end of 2024, and of course, it's been a mixed bag for a number of people, businesses, and of course, economies. Now, those that have been hit hard, of course, you have the Nigerian economy, the Ghanaian economy, and the Kenyan economy in a way, especially if you to go by the stance of currencies of these economies. We saw some losing by almost 30% ground to major international currencies, including the dollar and of course the euro. Now, among the winners for this year, especially as we're coming to the end of it, is Tanzania. The Tanzanian economy seems to have done quite well, and its currency has actually, to date, as we speak, strengthened quite firmly against major international currencies, specifically the dollar, the euro, and the pound. It is Money and Markets. Welcome to the show. Now, coming back home, and to start with, many have pointed to agriculture as a low-hanging fruit for this country. Of course, we've tried to look at areas like manufacturing and service delivery, but many still point to the fact that if you to elevate and lift many millions of Ugandans out of poverty, we need to pay special attention to the agricultural sector. And of course, in here, there are elements of adding value and consequently manufacturing, agro-based manufacturing.
Poverty is still a very big problem for our country, and that's why actually as Uganda Development Forum we come together to identify areas that can help our people to get out of poverty very quickly. One of those areas is agriculture. Agriculture has been proven across the continent that it can help more people to get out of poverty, at least in the short run. Of course, in the long run, you have manufacturing, you have education, and other key sectors, but agriculture is our biggest bet. But agriculture has many challenges. There are issues on productivity, especially for productivity. A couple of years ago, the World Bank issued a report saying that what they call it factor productivity, that if you combine labor, land, capital, entrepreneurship, and put them in one basket, what you put in is not what you get. That factor productivity has been negative for the last 20 years, so it has been going down. Can we improve farm productivity by getting government agencies that are supposed to do some work in this space, like NAROD, the research agency for Uganda, to do research that can enable our farmers to increase yields, to address the issues of climate change, to address issues of pests and diseases. So they come up with a seed, say for maize, that is resistant to heat, that is resistant to known pests and diseases, but can give our farmer a higher yield. That helps us to improve productivity. But also fertilizer usage is still very low. Our soils are very old. We are about 500 years. The other area we want to sort out is markets. Can we produce the right quantity with the right quality that the market demands at the right time? So that is a challenge that requires the farmers who are persuaded that there will be a fair price for their produce, who are well organized, because majority of our agriculture produce is done by smallholder farmers. So in order for it to be profitable, these farmers must be organized in some form of a producer organization or cooperatives. Back in a few years ago, when the World Food Program was still buying grain, a number of our private sector companies would go and source maize, beans, soya from the farmers, and then sell to the World Food Program, which was a big off-taker. Now, when they stopped, these buyers now had no guaranteed offtake. The South Sudanese market was almost closed because of the war there, and the non-payment and the risks involved. The Kenyan markets, as you heard, they were not resisting the sale of our produce there. So that left our companies with a lot of challenges, and they are not able now to have a guaranteed offtake. When they have no guaranteed offtake, they cannot source financing because the financiers will be coming and say, look, let me see who the offtaker is. And because of that challenge, access to finance becomes a problem. So when we set up this national marketing company, we expect to sort out a few things, provide offtake guarantee, provide a fair price for our farmers, ensuring that against that contract, the banks can lend. And when the banks lend, the buyers will now have money to go and buy the maize. The lack of an off-taker, a big off-taker and finance has also contributed to a lot of warehouse space in the country. These companies invested money. They invested the money for grain. But at the moment, those facilities are only utilizing about 30%. Government of Uganda has invested heavily in agro-processing facilities through programs like the Agriculture Cluster Development Project. But what we are seeing, OKAYIP, which is another project under the Ministry of Local Government, but what we are seeing is that we have so many of these facilities that are underutilized because of the factors I've talked about, and yet the farmers are available to produce. Of course, one of the biggest challenges as a developing country with minimal resources, you have so many quality development challenges. So while you're talking about insufficient roads, Uganda is probably the most networked country in East Africa, which means if one road is closed, you can use another. But that also comes with a huge maintenance budget. But overall, we are not generating enough money in the country to finance these large infrastructure projects. We had the other day, the president commissioned the construction of the standard gauge rail. That should also improve on the movement of our goods. But if we do not increase, if we don't increase domestic revenue generation, it becomes a big challenge. So one of the strategies is to increase domestic revenue generation, but which is also connected to increasing household incomes, because when people's incomes are higher, then they can pay taxes. When you collect taxes, we can then, of course, we also need to consider opportunities for the private sector.
In our big story, we're again still paying special attention to the major trends and developments driving this economy. Take a look. Bank of Uganda is counting on its recent decision to buy gold from, among others, artisanal miners in the country to rein in the current account deficit, which stood at $4.4 billion, roughly 16 trillion Uganda shillings, in the past 12 months to April 2024. A current account deficit occurs when the total value of goods and services a country imports exceeds the total value of goods and services it exports. For Uganda, this has been steadily increasing in the recent past, partly driven by the country's investment in infrastructure and oil-related constructions, which heavily rely on imported items, against relatively fewer exports. In its recently published report on the state of the economy, the central bank asserts that the move to buy gold locally will help it accumulate international reserves, and at the same time, it expects imports of raw gold to reduce, contributing to the reduction in the total imports, and in turn leading to a decrease in both trade deficit and the current account deficit. To finance the current account deficit, the central bank is also counting on foreign direct investment, which is projected to expand in the next 2 years and is expected to be the main source of funding to bridge this gap. In the medium term, the report says the trade deficit is expected to narrow, supposedly by the oil export revenues, starting in financial year 2025/26 and gradually rising in the years ahead. The first oil production is expected in 2025/26 and is expected to accelerate to 230,000 barrels per day in the outer years. Overall, the report paints an optimistic economic growth outlook of between 6 to 6.5% this financial year, but is however quick to add the threats to this projection, notably a weaker global economy, reduced export demand, high freight costs, unfavorable weather conditions, among others.